I'm about to show you how I made a 14% return on a stock, even as the share price went nowhere, and how I made over $6,000 on the investment. In this video, I'll reveal how I used the covered call option strategy to produce cash flow, limit risk, and lower my cost. We're talking covered calls explained today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, who doesn't like getting paid to invest? You know I'm a big fan of those dividend stocks, but some of the best companies out there don't pay dividends. Shares of Tesla up more than 8-fold in the past year, no dividend. Shares of Amazon up 70%, but no cash flow until you sell the stock. In this video, I'll show you how I use covered calls, a simple option strategy to not only create cash flow from these stocks, but also how they lower my risk and help boost my returns. This is by far my favorite options trading strategy. I've used it on shares of Teva to make an extra $6,000 even as the share price went nowhere. Here I used it on GE after the company cut its dividend, creating $1.47 per share in dividends on this strategy. The video is actually a collaboration with Thomas Carvo following a great video he did a couple of months ago on how to trade options. He did such a great job explaining options basics like intrinsic value and volatility that we started talking about some of our favorite strategies that we like using. So in this video, I'm not going to cover some of the options basics that Thomas covered. Instead, I'm going to pick off where he left off, walk you through the covered call strategy, when you might use it, and how to set it up. I'll be linking to Thomas's video in the description below, so check that out. He uses a great example of using longer dated options contracts on shares of Apple based on some technical indicators that you'll definitely want to watch. Before we get started though, I want to throw this out to the community. What do you want to do with these options investments? Would you rather cash flow your stocks, maybe lower your risk, or make those higher returns? Scroll down and let me know in the comments so I can put together more options trading videos to fit your needs. First here, I'm going to take you through the basics of call options, and I'll use plenty of examples here because I know this can be very confusing when you're just starting out. I'll leave a clickable index in the video description below if you want to skip over some of these basics. Now stick with me though, give it a little bit of time to get these basics down because I guarantee, Nation, once you start using this strategy, it's going to change the way you invest. Call options are an investment that lets you buy the right to get shares for a certain price from now to some point in the future. Let's use an example with Amazon call options here, and I think it's going to start making sense. Here we have the call options for Amazon that expire on January 21st of next year. That's 2022. So for the first thing you notice is that you can buy these investments for different dates. You see across the top here that Amazon has call options that expire every month, and in fact, you can get options expiring in as little as a week. Now look at the column on the left, that one called strike price. That's the price of Amazon shares that you're getting. In this first row, that strike price of $3,150, that means if you buy these call options, that gives you the right to buy shares of Amazon for $3,150 each up until that expiration, January 2022. That's a pretty sweet deal, right? Shares of the e-commerce giant are already trading for $3,165 right now, but you can get them for less than that? But hold up, now look at the column in the middle where it says last. That's the price of these options, the last price at which these options were traded. So to get that right to buy shares of Amazon for that strike price, you have to pay for those options, what's called the premium. So again, in that first row, you pay $461.07 per share now, then that's going to give you the right to buy those shares of Amazon at any time until options expiration for the strike price of $3,150 each. Now, if we add up the two, $3,611 per share doesn't sound like such a great deal, but remember, you've now locked in that strike price for all that time. Almost an entire year in this case, and even if shares of Amazon surge to like $4,000 by next January, you can buy them for $3,150 each and make a huge profit. Now, on the other hand, if Amazon falls below that $3,150 each, then I don't have to do anything. I paid for these call options, but I don't have to use them if the share price is below the strike price. I'm out the $461 I paid for the options, but I can just pick up the shares in the market for less. And notice also that there are strike prices here from that first one all the way up to $4,250 per share. In fact, I cropped the table here so we could see the whole thing, but there are strike prices for Amazon from $800 a share up to $5,300 each, and notice that the price of these options changes. Whereas I had to pay almost $500 to get the right to buy Amazon for that $3,150 a share, look at the last row here. I only have to pay $147.80 to be able to buy Amazon for that $4,250 at any point until that option expires. And I already see some eyes glazing over out there. You might have to watch that explanation a few more times just to get a good feel for how options work. Don't worry about it. It took me years to figure out options. But now we're going to use that to explain the covered call strategy and how it can help you do everything from cash flowing a stock to reducing your risk. The covered call strategy is where you own shares of stock, own shares of a company, and then use call options to sell someone else the right to buy those shares from you. Now, instead of buying those call options that we just talked about, you're selling them and collecting that money. So if we look at that table again, let's say we just bought shares of Amazon for that $3,165 each. If we sell the call options with a strike price of $4,250 each per share, then another investor is going to pay us that $147.80 per share for each option they buy. Now I'm going to show you exactly how to set up this covered call strategy later, how to sell those call options. But for now, just think about what this means. You're immediately collecting that $147.80 for each share of Amazon that you own. At a cost of $3,165 for the share, that's a 4.67% of what you paid that you just collected in cash. That's a hell of a dividend for a stock that doesn't pay anything until you sell it. What's more though is you keep that premium, that $147 per share, no matter what happens. If the shares don't rise to that $4,250 strike price by next January, then the call buyer isn't going to do anything. You keep your shares and you can sell another call against that to collect more money. Now, if shares of Amazon do rise above that $4,250 strike price, you sell the shares for that amount to the call buyer for a 34% return plus the 4.67% return that you made collecting the premium. And there are really three reasons that you would use this covered call strategy: to lower your short-term risk, produce cash from a stock holding, or to lower your cost basis in the shares. Going back to our Amazon example, if I like the company for that long-term investment, but maybe I'm worried here that people are going to be shifting their spending back offline and sales are going to be lower in the short term, I can go in here and sell the calls with that $3,300 strike price and collect $401.55 a share. So even if the stock does drop $400, that would be a loss of 12.6% on the current price. I'm protected because I collected that much in that call option. And for this kind of short-term protection, you would usually use closer dated options. So maybe the option's dated just a few months out, and you would sell the calls with a strike price that's close to that current price. That's going to give you the maximum downside protection that you want over that short-term period. You might also use this covered call strategy to cash flow a non-dividend paying stock that you own by collecting that premium on the calls. Back to our earlier example of Amazon, I can sell the calls with a $4,250 strike price for $147 each. That means the shares can rise 34% higher and I still keep them and I collect that cash equal to about 4.7% dividend on the current price. Now for this kind of a call option strategy, you would usually want to use options with that higher strike price. Basically, you do your research to figure out a target price for the shares, a price that you would be happy selling them at, and then use that as your call option strike price. That way, if the shares do reach that price, you're happy with the return and the cash you collected. One more reason to use the covered call strategy, then I'll show you the risks and how to set this up, but you might also use this to lower your cost basis in the stock. And here, Amazon is the perfect example, with one single share of stock going to cost you $3,165. In the other examples, I've sold call options on shares that I already owned. Now in this, I can buy a stock and sell the options at the same time. Here I am on the order screen and you can see I'm buying 100 shares of Amazon and then going to sell call options against that. That's one contract worth 100 shares. Now the stock price is $3,171.25 and the option premium is trading for about $306 at that midpoint between the bid and the ask prices. And you see here below, I've made this a net debit trade. I've told the platform that I want to buy the shares and sell the call option immediately for a net cost of $2,865.25 per share. That's the share price minus the $306 per share for the call options. And if I click preview order, then execute here, the platform is going to try to fill at that price. I'll essentially be getting shares of Amazon for a 9.6% discount because of that $306 that I'm collecting in this covered call strategy. Now, as we say here in the Bowtie Nation, it ain't all rainbows and unicorns. There are risks to the covered call strategy, so I want to go over those before I show you exactly how to set this up on your own. There are really two risks with that covered call strategy. One is that the stock price could drop further than the amount you collected on those options. With my GE position here, I bought the shares for $9.87 each and sold the calls for $1.47, so that was almost a 15% downside protection. The $9.87 minus that $1.47 collected from the calls, that protected me to $8.40 each. Now, if shares of GE fell further though, and at one point last year they traded for $5.48 each, then I would still be at a loss on the investment. My cost basis was that $8.40, but it didn't protect me from losing money as the shares dropped below that point. But you know, this isn't the worst risk because I still get to keep the shares and that call premium that I collected. With that lower cost basis, I'm not out as much as investors that just bought the shares flat out and didn't use that covered call strategy. The bigger risk to this strategy is if the share price booms higher and you miss out on some of those gains. Now remember, selling calls means you give someone else the right to buy those shares off you at that price. So if I sold these GE calls with a $12 strike price and the shares jumped to $15 each, that investor is going to be able to use those call options to buy GE off me for $12 a share. Now in this case, I keep the $1.47 that I collected selling those calls. That never changes. And I sell the shares to the investor for $12 each. So my return is on that $13.47 per share. That's a nice 36% gain from that $9.87 a share that I paid, but I could have made 52% if I hadn't sold those call options and was able to sell at that $15 per share price. And Nation, I gotta tell you, that last risk can be heartbreaking, especially if you've sold calls on a stock and it just soars higher, because you're basically left looking at your account, seeing how much you could have made on that stock. And that just makes it super important to set your strike price where you'd be happy to sell the stock, at that return that you'd be happy with, and then just be happy with that. For that, I'm going to show you exactly how to set up this strategy and pick a strike price that you can be happy with. Now, I'm going to show you how to set up that covered call strategy. But first, I want to personally invite you to get the Daily Bowtie, my daily market newsletter with all the important news, stock market trends, and what to watch, all delivered straight to your inbox the night before so you have time to plan your day. It's your opportunity to be a smarter investor in less than 5 minutes a day. This is something completely new for this year, something I've been wanting to do for you out there in the community for a long time, and it's totally free. So look for that link in the video description below to sign up. So let's look at how to set up this covered call strategy. And we already looked at an example where we buy the shares and then sell the calls against them at the same time. So let's here look at an example where you already own the stock and want to sell calls against those. I'm going to use E-Trade here, but the process is identical on almost any investing site. I'm here on shares of GE, and let's say I own 1,000 shares. I can go here to options in the menu and see all the options trading for that stock. Again, notice that you can buy or sell options that expire in a bunch of dates, anywhere from the next few weeks all the way to a year or more in advance. Understand though that with more time left to expiration, the price of that option, the premium, is going to increase because there's more time left for that stock price to move. So we'll scroll over and say we want to cover our shares through June of this year, about 6 months from now. Now this is really your first question that you need to answer in setting up your covered call strategy. Which options expiration date do you want? And that's going to depend really on your reasons and your outlook for the shares. For example, maybe I like GE for that long-term investment, but I think the shares have already run up a lot, and I'm a little worried about the next 6 months, or maybe I want protection for the full year. You can look through each month's options to see which you think gives you that best trade-off between the higher premiums, because that's the cash that you're going to collect, and then the time that you have to hold that call option. So I'm here on the options that expire in June, and I can change this drop-down to show more strike prices. Here I can see options with strike prices from $7 a share to as high as $20 each. And again here, note that as this strike price increases, the premium that you collect for those calls, here this last column, that's going to decrease as well. Someone isn't going to pay me as much for the right to buy shares of GE for $20 through June if the share price is right now just $11.62 each. But let's say here I pick the $15 strike price to sell those calls. And that's the second question that you have to answer. At which strike price do you want to sell calls against your stock? Higher strike prices mean less of a chance that your shares are going to be called away, that the call buyer is going to buy your shares for you at that amount, but it also means less money you get to collect right now. There's a very slim chance that GE is going to rise 72% to $20 a share by June, but then again, I only get $13 a share if I sell those calls. On the other hand, sell the $12 calls, which are just above the current price. That's going to get me $1.24 per share in that immediate cash. Again though, the strike price you pick is going to depend on your outlook for the stock and a price that you'd be happy selling it at. In this example, shares of GE are already up 91% in the last 4 months and right around the analyst price targets for the next year, so there might not be much room to run. The company is still struggling with debt and a couple of its segments, so I'm going to set my price target a little bit lower here at that $15 a share, which would still be a great 28% higher from here. And don't forget to check out Thomas's option video linked below. He shares some tips on technical analysis that can really help you pick your strike price on this strategy. Now here on the order screen, you want to set an order to sell open. That means you're opening in a position to sell these calls. We'll put in a quantity of 10 here because remember, each options contract is worth 100 shares. So if I own 1,000 shares of GE and want to cover them by selling those call options, then I would sell 10 options contracts, each covering the 100 shares. We can see here that currently investors are offering to buy the option for 44 cents each. That's the bid price. While there's other orders here in the market to sell the option for 46 cents each, and that's the ask price. Now that's a really tight bid-ask spread because there's lots of investor interest in buying and selling GE. For this, you could probably just do a market order price type because 1 penny difference isn't going to matter much, but I almost always do this limit order for that price type and set the price that I want to sell the calls for. So I'll tell the platform that I want to sell these options for no less than 45 cents each, which is right in the middle of that bid and ask spread that I should be able to get that price. And I see that if I click preview and execute here, then I'll receive approximately $443 after commissions for selling those calls. And that's how you set up the covered call strategy. You'll hold the shares and collect any dividends declared on that stock. Your account's also going to show a negative amount for the value of those call options, basically the remaining premium left on those options. And now a few things you can do with this. You can hold those calls until they expire. So as they get closer to expiration, the value of that call option is going to go down as that time value falls away, and the option is going to be worth closer to the current share price plus the strike price, so that intrinsic value. You can also always buy the calls back at the current premium price and then just hold the shares for as long as you like. For example, here the price of Tiva is getting close to those $10 calls that I sold, so maybe I want to buy those back for the 72 cents each. That's the current price the calls are trading for in the market. Now I keep the difference in the $1.08 that I collected when I sold those and the 72 cents each that I'm now paying for a profit of $347, and I get to keep the shares even if they rise above that $10 each. And I can do this no matter where the current share price is at. If shares of Tiva jump to $12 each, so that call, that $10 strike price call would be in the money and the premium would be somewhere north of $2 each, I can still buy those back. I buy the current premium on the options, which means I'd be taking a loss on that call option, but I would get to keep the shares and could sell them for that $12 instead of the $10 on the option. But if I do hold those call options to expiration, then what happens depends on where the stock price is and that strike price. With these options, since Tiva is at $9.67 a share, currently below that $10 strike price and the $13 options, I keep all my shares and nothing happens. The investor that bought those calls from me, they're not going to pay me $10 or $13 for the shares if they can just go into the market and buy them for less. Now, if on the other hand, let's say Tiva is trading for that $12 a share at the expiration of these call options on that January 15th, 2021, the investor that bought the $10 call options from me would use that option. The platform would probably automatically sell my shares to them for that $10 each, and I would be down to 4,000 shares of Tiva. Notice though that I would still keep those remaining shares because the $13 call option, that would expire worthless. The strike price is still over that $12 current price on Tiva. Nation, I know it's a lot to work out, and don't expect to be a covered call options master in less than 20 minutes. Watch through the video again to pick up those details. Check out Thomas's Options Trading Basics video that I'll link in the description below, and put this option strategy in your toolbox. Click on the video to the right for my 5 favorite options trading strategies, a step-by-step on how I use options investing. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.